Hey guys, what's up? We have 6 concurrent viewers. I hope you're doing fine. I just got back from my last week of vacation, so we're just getting back in business. A lot of interesting stuff is going to be revealed to you in the next couple of months. Do we have anyone here? Please just let me know that you can hear me in the chat. Right, so today we're going to look at the results as usual. We're going to go through the basics of walk forward optimization. And please let me know if there is any other topic that you would like me to cover today. If it's a too complex topic, I will schedule it for next month, but if it's anything just easier to cover, I will do it tonight. Hi, Be Art of Noise. Yep. Tell us about coming things. I can't, not yet. Probably in the next video. Or in the next live stream. Alright, so I think most of our viewers are on vacation, so we will only probably be this many today. I'm going to go through the walk forward testing in ProRealTime. I hope that anyone watching this after today will benefit from this as well. But any viewers watching this now, please let me know if you have any questions during this small short learning video. Right, so let me pull up a screen. Let's do it like this instead. Right, so walk forward testing. We have to start with the basics, so anyone that already know this, please bear with me, but it's important to start with the basics of optimization and testing. So how do you know if a strategy will make you money? Well, first of all, you have to test it, and walk forward testing is the best way to do that. So there are multiple ways to test a strategy, and the easiest but most expensive way would be just to start every strategy right away with real money, meaning that you will test it live. So here are 4 ways to test a strategy. The first one I would like to call real money testing live. So this type of testing is just basically not even testing. You come up with an idea and you start trading it right away. So I have put up a calendar here of I think it's 11 years from 2013 to 2024. So if you would do a real money testing live, you would have not tested it on any of the years until you actually started. And that's when the 2 terms in sample and out of sample comes into context. So in sample is data. In sample data is data that you optimize your variables on, that is in your backtest. Out of sample data is data that's not considered in the backtest. It can be running it live, or it can also be just to make an ordinary backtest, but you have not optimized your variables on that data. So if you would be running a real money testing live, this is how that would look. You would have 8 years without any testing, and then you have all dates after today would be considered out of sample. So what most people do is simple optimization. That's the second type of testing, and that is that you optimize your trading strategy with the whole data period that you have access to, and that this is what most rookies do, and it's a big risk of curve fitting. So what you do is that you take, if you let's say have 10 years of historical data, you from today and back 10 years, you run a back test of 10 years optimizing your variables on the 10 years of historic data until today, and then you start it. And that's when it looks like this. You have in sample data of all the historic data that you have access to, and your out of sample data is from today and forward. The third type of testing is out of sample testing. I think most people have heard of this, and this is what most people usually do. And what that means is that you optimize your strategy for let's say X%, let's say 80% of the historic data, and then you verify it with the rest, meaning that you verify it on the 20% of the data. So in this example, you would run optimization on 1, 2, 3, 4, 5, 6, 7, and 8 years of data, and then you would test it on 2 years of data. And after running it live, that of course is also considered out of sample. So that's the introduction to testing. What I would like you to know, or the basics of it all, is that it's a strategy that's showing good results and a good performance on your out of sample period is considered much better than a strategy showing only good results in the in sample period. So let's say that you have 10 years of historical data, and if you run a variable optimization on 10 years of data, odds are that the back test of those 10 years will look amazing. But the problem with that is that you are curve fitting your algo. And one way to make sure that you don't curve fit your algo is to have a good amount of out of sample data. So in this 10-year example, one ratio could be to have a 80% in sample period and a 20% out of sample period. And what you would like to see is an out of sample period that's similar to the results of the in sample period. And I will go through this in detail. I will go through it in ProRealTime, and I will show you exactly how it will look like. So this will not only be learning in theory, but let's go to walk forward testing. What is that? It's an concept that I have seen been misunderstood in many places of this algo development, especially on the ProReal Code forum. We have people looking for a walk forward efficiency, saying that you should have a walk forward efficiency of 100% for each iteration, and it's just a lot of misunderstandings of this concept. And let me show you what a walk forward optimization is. So walk forward testing or walk forward optimization is that you optimize your strategy in iterations with X% of historical data, and then you confirm it with Y% of out of sample data. And in this example, we have 5 iterations with 5 years in sample and 1 year out of sample. So here's the first iteration. Let's say that you have 10 years of historical data, but you don't want to use it all on your in-sample backtest optimization. You want as much as out of sample data as possible. So this is a good way to get a big amount of out of sample data, so that you can be sure that your algo have the best possible chances to actually make you money and not only be presenting a good backtest. So in the first iteration, you run optimization of 5 years and you test it on 1 year. So what this means is that you optimize your variables on 5 years, and then you use the optimal variable for those 5 years on the 6th year. What you do next is that you make a second iteration. You do it on the year 2, but you still do 5 years of optimization, and you use the optimal variable of those 5 years on your 6th year, and so on. In this example, we have 5 iterations, and what you get here is actually out of 10 years of historical data, you get 1, 2, 3, 4, and 5 years of out of sample data. So this is a good way to test your algos and see how the algo will perform when re-optimizing it, in this example, every 5 years. So what you would like to see here to know that an algo is actually good and have a good potential making you money in the future, this is what you look at. You want to see that the out of sample periods make money, but you would more than just make you money. It should present similar results like the in sample period. And that's it. Let's see if I have some questions. No questions yet. Let's go into the comparison. So here are the 5 different ways of testing. I covered them very quickly. So and we will rate these different methods on how complex they are, how reliable they are, how long the out of sample period is, and how big the chance is that it will perform once you start it live. So real money testing live, it's a small complexity. It doesn't require much work. You just come up with the idea and you start running it live. But is the results reliable? Yes, it is. The results that you actually get live is the real results. How long is your out of sample data period? It's none. You have not tested it at all, so your out of sample period is nothing. And how is the chance, how big is the chance that it will perform live? And that's not really applicable, since it's just you have no actual basis or backtest to be the basis of you have no backtest to I mean this metric here is how good are the chances that it will perform similar to the test results, but you don't have any prior test results, so it's not applicable on this type of testing. Simple optimization, this is what most rookies do. You start with algo trading and you want to get that good looking backtest, and that's what you do. You use the whole data period, let's say it's 10 years, and you use 10 years of that data to make a good looking backtest, thinking that will create an algo that will make you money. But it doesn't. It will not do that. So, but the complexity is quite small. You only run a optimization once, and then you start it once your optimization looks good. Is the results reliable? No. This is the biggest mistake that rookies do. They think that the backtest of a 100% in sample variable optimization is reliable, but it's not. I would say it's better to not optimize it at all. The out of sample data period is none. You are using the whole 100% of the historic data in your in sample backtest. And chance it will perform live, it will not do that. It will lose you money with very high odds. Sorry, it's low odds. Out of sample testing, that's the, now we're getting to what you should do. Out of sample testing is just you can think of out of sample testing as one iteration of walk forward testing. It's a medium complexity. It takes a little bit longer time. Let's say that you're running an 80% and a 20% in sample optimization. What you do then is that you run an optimization on the 80% of the historical data, and then you take those variables and those optimal variables, and then you run it on the rest of the 20% to see how it performs out of sample. So it takes a little bit longer time than what simple optimization will do. Reliable? Not really. It's better than the simple optimization, but 20% out of sample is not very good. Let's say that you would run 10% in sample and 90% out of sample. Then I would say that the reliability is much higher. So the reliability depends on how much in sample and how much out of sample data you are using. The short period, out of sample data is a short period. It's only 20% in this example. Chance it will perform live. It's a better chance than simple optimization, but it's still not good enough. Now, manual walk forward testing. If you would do it manually, it would take a lot of time. You would have to run each optimization for each iteration, and then you would have to run it on the out of sample period for every iteration. So that would take a lot of time. Thankfully, ProRealTime have a function for this, and that is what I was going to cover in this video. But let's talk about the metrics here. We have reliability that's likely. We have a long out of sample period, the longest that you can possibly get without using a very, very small in sample period. It's a high chance that it will perform live if the out of sample walk forward test is good. All right, let's start ProRealTime. Maybe first I should cover what curve fitting is. I hope you remember that I mentioned that if you do a simple optimization, meaning that you're running an optimization of 100% of the historical data, you have a big risk of curve fitting that strategy. And what is curve fitting? I will cover it just quickly now. Let's see. I have prepared a chart here. So here are a chart, and we will use, here's 2 weeks, 2 trading weeks. We will use the first trading weeks as in sample data, and we will use the second trading week as out of sample data. So what that means is that we will optimize the system for the first week, and we will test how it runs on the second week. Right, so this chart shows these dots are trades or potential trades. The red dots are, let me zoom in a little bit. The red dots are losses, and the green dots are wins. So these are potential trades. You have 5 potential trades per day, and what the y-axis is the time of the day, and the x-axis is the day of the week. So let's say that you're building an algo and you want to optimize it on the entry time. You want to optimize the time of the day and the day of the week on which you enter trades. So here are all potential trades. You see that there are 5 winning trades and 20 losses. So if you would be curve fitting this this strategy, what would happen is, I've shown this before, I'm just going to go through it again. So if you were to optimize your strategy too hard, then what would happen is that you would build an algo that looks like this. Consider this this line here that I draw the system in itself. So you would optimize it, and you would see that the system that you have built will enter trades on Mondays at 8, and it would enter trades on Tuesdays at 10, and on Wednesdays at 10, on Thursdays at 12, and on Fridays at 14 at 2 p.m. So this would, if you were to optimize it too hard, this is how that system will look. You would have 5 wins and 0 losses, because you have optimized it very, very distinctly, so that you have made sure that you have no actual losses. So you're thinking, wow, this looks like an awesome algo. I have 100% win rate. I have 5 trades and a 100% win rate. This system should perform very well starting it live. But what you will notice is I will copy this system just as we have built it, and we will test it on the out of sample period. And what you can see, let me just say that first, what you can see here, just looking at these out of sample data, is it is very similar to the in sample data. It looks like this specific strategy have an edge going into trades early on Mondays, around lunch, or early on Tuesdays and Wednesdays, and later on the week you should enter the trades later at the day. And if you look at the out of sample period results, you can see, well, it looks the same. You should enter trades early on Monday, around lunch on Tuesday and Wednesday, Thursday and Friday. So and on Thursday and Friday you should enter the trades a little bit later. And you're thinking, wow, this should work. And then you copy that exact same strategy, you place it over your out of sample period, and this is what you get. You get 4 losses and 1 win. And that is curve fitting. So it's a good example. It's a good way to think about your system like a curve. And if you are curve fitting it, you are making your curve look very good on your in sample data. You will see that the curve are only following the big, only covering the wins and are avoiding a lot of the losses. But this is what will happen if you are curve fitting. You will get an out of sample result that is horrendous. In this example, 4 losses and 1 win. So what you would like to do is to make a system, and if you are thinking about it like a brush, you should be thinking that you should optimize your system to you should optimize your system so that this brush covers wins but also losses. In this example, you should have a brush that's something like this. So what you get here in your backtest is, all right, I got 5 losses and I got 5 wins. That looks worse than the last backtest, but if we are going to copy it to the next out of sample period, it will perform also in your out of sample period. All right, so that's curve fitting, and that is what you want to avoid. And if you are running a walk forward optimization testing, you will avoid that by just the nature of it all, and automatically. You don't have to think about it. All right, let's go into ProRealTime. Please let me know if you have any questions about that. Right, so let's do a walk forward testing. Let's start by doing it manually so that you get the sense of it all. Right, let's make a daily long strategy on the DAX market. Let's call it the daily live stream. Right, so what we want to do is make a simple system just to showcase how this works. Right, so we are building a system that will enter trades if the RSI value of 14 is below our variable that we will optimize. And we will enter exit condition as well. So we will exit the trade if we have been in the trades more than 3 days. Right, and for you who haven't even gone into the optimization part of ProRealTime, what you do is you click here on variable optimization. You add the variable name that you have put in the code. Some variable names are already taken. I usually use the alphabet, but if you come to H, it's used as, I think it's taken by the ProRealTime system as the hourly time unit. But we are using X, and we will run a simple optimization of 5 to 95. So what this will do is it will run optimization of this variable. We will check, we will run it from the value 5 until 95, and we will use our interval of 5. And let's start with that, and we'll go into the walk forward part down here later. We're going to do it manually on the first time, so let's try that. And we will let's not use a spread, doesn't matter for this example. Getting some error messages. Let's see. I'm not sure what's happening. All right, so we have, let's do it from 2013. Let's change the time period to start from 2013 as we have it in the Excel sheet. And let's do an iteration of 7 years in sample and 1 year out of sample. So let's run the optimization out in sample part from January 1st in 2013 until January 1st of 2020. Right, so this is the optimization report. It will show you the results, the gain, the win rate, and the average gain, and so forth. And to the right here, you will see the optimal value to use in the historic data that you have run the optimization on. So for this 7-year period, the best possible results have been using RSE 14 value of 45. So, and here's the equity curve of that, and you could try another one. Let's just see how it looks for RSE value of 30, and you will see that it is performing not as good. So here we have the optimal variable value is 45, and we have run it on 7 years of in sample period. Now we're going to use the value of 45 on the 1 year of out of sample period. So what you do then is you go into the variable optimization, you set a fixed value of that variable to 45, and you run it on the remaining 1 year of historic data. And here's the result. What you can see here is that it made a loss of 21.6 euros. So if we go to our Excel sheet, we would have in sample data of let's see, we made optimizations from 2013 until 2020, and we had out of sample data period of 1 year, and it lost us 23.6 euros. Right, and now we're going to do the second step, which is to run an optimization of 7 years, but we will run it starting on year 2. And we will get the optimization data, out of sample data for that year. Let's see. So, okay, all right. So now we are changing the date to 2014. And we are running the test until 2021. and we have to optimize that, activate optimization again. Right, so for this period the best ROC value was 55. So let's try that on the remaining 1 year out of sample data. 55. Right, and here is the result for that. We made a win of €2,000. Oh, that's a lot. Right, so we made a gain of €2,036. And that is how you do a manual walk forward optimization. But as you see, this takes a lot of time, and this is only using one variable. Unfortunately, now I understand that we don't have any auto sample data after 2022. So let's just think that we made a gain of let's say €550. So this is a good auto sample period. We got three auto sample years, and two have been winning. Two of the years have been positive, and one have been a loss. So that's how you run a manual walk forward testing in ProRealTime. But fortunately, we have an automatic walk forward engine in ProRealTime. Let me show you how that works. So go back to your code, click active on your walk forward optimizations. Here is the number of iterations. In this example, we used 3, and we had in sample period of 7 years and an out of sample period of 1 year. But and how? Let me just calculate what that is. Let's see. 87.5% and 13%. So this is actually you're recognizing this this candlestick chart. Sorry, this candle chart. It looks like the calendar chart that we have here. If we were to increase, let's say, to 6 iterations, I think you get the point. The blue part of the candle here is the in sample period, and the gray part is the out of sample period. But in this example, we were only to use 3 iterations, and then you run the optimization in the same way as we did before. And here are the results. And when you run an walk forward optimization, you will get an extra tab here on the detailed report. It says walk forward statistics, and what you'll see here is how the algo have been performing since you'll see the 3 iterations. In the first iteration was from 2021, the in sample period, to until 2021 in September. Why is that? Oh, I just noticed I hadn't changed the date here. So let's change that back to 2013 and rerun the optimization. Right, here it is. Right, so the in sample period of the first iteration was between these dates. And how did the system perform with the optimal variable considering this period? How did it perform in the out of sample period that was between these dates? And what you can see here is that it was actually performing very good. So this gain here is the total gain of the 7 years of in sample period, and this gain here is the gain of the out of sample period. But the in sample period was 7 years and the out of sample period was only 1 year. And what you can see is the walk forward efficiency here. It's saying how well did the algo perform in the out of sample period compared to the in sample period, and it's considering the length of the period as well. And what you can see, and what this means, is that the walk forward efficiency was 456%, meaning that the out of sample period was actually 4.5% better than the in sample period. Luckily, we have a period here where the results were actually worse than the in-sample period. So the second iteration was from 2013 until 2020. And that's 7 years of in-sample period, and we made a gain of 5,637 euros during that period. And the in-sample period was 1 year after that. And what you can see is that the in-sample period did perform better per year. So the walk forward efficiency was below 100. So this is walk forward optimization in ProRealTime. I would recommend that you try this manually first, that you run an optimization, you add it to your Excel sheet, you run a second optimization with new dates, you add it to your Excel sheet, and you run a third optimization and you add it to your Excel sheet, so that you get an understanding of how the walk forward optimization is working. So you should know that building a system with using walk forward optimization, it is harder. It will take you a little bit more time to find the system that is actually performing well in all your iterations of your walk forward test. And what you also should know is that if you are running an optimization of 10 years, what we call a simple optimization is if you run a 10-year optimization. If you have only 10 years of historical data, that backtest will 100% of the times, every time, will show better results in your backtest than any walk forward test. And why is that? Well, if you're running an historical data optimization on 10 years of data, it will show you what variable value was best for this 10 years of historical data, and it will give you the value that will give you the biggest gains of these 10 years. So if you were to run a walk forward optimization but only using let's say but with around 30% of out of sample period, you will not get the total gain as you did in the if you were to run an optimization of the whole period. So that is something that you should be aware of, that your backtest will look worse, but odds are that the algo will actually perform better once you run it live. Now I've been talking a lot. Do we have any questions? Not yet. Yeah, that is walk forward optimization. I'm not sure if there is any other questions. We will do a short edited video covering this in a bit more clear manner, but it's a good repetition for me to talk about this stuff. let's look at the results of the week. Bit of noise. Can you go over your website page to page? What is actual data? What's not anymore? What is realistic? What is simulated? Yeah, let's do that. Alright, let's see. It's unusually slow. I'm not sure what's happening. Hello. Basically, all data is real data. We have just. I'm thinking that you are. I'm suspecting that you're thinking about the new chart that we have on our website, but I can show it here. Right, so we have added a new chart here. I hope you've seen it. This is the green line here. This is the. On the previous chart we had only one line in the chart, and that is actually this green chart. It's the same values, and what that is running all algos with minimum position size, or actually the results is running. I see that we have lost the position sizes here, but it's basically running the algos with minimum position sizes. For DAX and for US 100, that is running with one euro contract. But for SP500 to factorize the fact that SP500 have a lot that the value of SP500 is a lot smaller, that means that we have to factorize the minimum position size. So for SP500, for example, we are using 3 contracts, and we should add that here again. But what you see, the other 2 lines here is it's not hypothetical. It's just it's showing how powerful it would be, for this example, if you reinvested the profit that you made. So it's still based on real data, on real results. It's based on this green line here, and that is the equity of our ProRealTime account that we go through every month. But what we have done is that we have added functionality. It's also added in the algos so that you can actually just activate it if you would like. It's that you increase the position size 1.25, so increase the position size 25% when you have reached a level of 4,000 euros in equity. So every 4,000 euros made, we increase the position size 25%. And what you can see here is, without reinvesting the profit, you would have made a gain of 18,843 euros, but with the profits reinvested, you would have made a gain of 32,401 euros. But as you can see, the drawdown periods are, of course, bigger because you're running a bigger contract size. But also your winning months will be better than if you would not have reinvested your profits. The black line is just simply the minimum position size times 2, and then we have 2 other lines here. That is the DAX 40 and the Nasdaq, just showing how good our algos are compared to just a buy and hold strategy. All these results here are real results. These are real results as well. It's also with minimum position size. Let's go to results page. It's the same chart here. These are also real results, meaning that these are the position size that we are running on our reference account. So these are automatically updated from our ProRealTime account. We don't make any adjustment to this manually. It's just automatically updated. Yeah, and I think that's it. So profits reinvested, yeah, you could consider that simulated data, but it's basically just increasing your position size 25% for every 4,000 euros made. So if you would, we actually added an equity line of how the equity would look if we had reinvestment of profits using the double size. But what happened there is that the results were actually going up so high, the result was so good that you barely couldn't even see the difference between these 2 lines here. So what this shows is that reinvesting profits is incredibly powerful. Please let me know if you have any other questions. I hope you understood my walk forward presentation. So the basics are just knowing that having loads of auto sample data and having that strategy showing good results on that auto sample data is likely to mean that your algos will perform better than running a full backtest of the whole historical data that you have access to. Can you show in future also the 5 worst algos? The 5 worst algos. So what we are doing on a monthly basis is that we are stopping algos if they have performed badly, and we try to do this as quickly as possible so that the algo on a total, if you're looking on the total lifetime of an algo, you still want the algo to have made money. So we are trying to shut down algos that obviously have lost its edge in the market. We have a couple of algos that have actually had a loss looking at the total lifetime of the algo, and yeah, so you want to see, I guess what you're asking for is the 5 out of the 20 active algos, which are the 5 that have performed worst in. I'm thinking that you're meaning last month or since the start. Yeah, what we should do is to add in the future add a separate equity line for every single algo. Today we only have it for the aggregated results of all 20 algos. So what you could expect in the future is an equity line for every single algo. If you want this today, you will have to run a back test of all 20 algos. So that would take you a bit longer time, so to say. Yeah, I think that's it. Yep. Yeah, that's true. So, and that's true for even just regular like stock investing. In my experience, you have 20 stocks and 17 out, so you can be barely break even because 2 or 3 out of those stocks actually have performed so bad that the 17 other stocks making money barely covers up for those losses. So I think a key to our success in our algo trading have been when to stop an algo. I think it's easier to know when to start an algo or when to invest in a stock, but it's harder to know when to stop an algo or to sell a stock. And I think a part of our success comes from the fact that we have been good in determining when to stop an algo. There's always a risk that you stop an algo, but it's only a temporary drawdown period, and that's not unusual. So there are no algos that will perform every single month. Sooner or later, an algo will start having losing months, and the problem is knowing when to stop that algo. All right, I think that's it for today. We have been live for almost 1 hour. If you're interested in knowing more about walk-forward testing, we will go into more details in a coming video of our learning program. The learning program is much more condensed and rehearsed. So this live video, this live stream covers walk-forward testing covered the walk-forward testing in the basics of it. But if you want to know more and you want to know how the walk-forward efficiency should look like, how many are the recommended number of iterations, if you should be running an anchored or non-anchored walk-forward testing, those are the stuff that we will cover in our learning program. The learning program is free, and you sign up by going to our website, click on Learn to Code, and just sign up. It's free, and I think that's it for today. I don't have anything more to talk about. I hope you enjoyed this video. I will talk to you again next month, and that will be in the beginning of September. It will be specifically on September 4th at 8 p.m. So it has been nice to talk to you. I hope we have more viewers next month when vacation is over. Right. Have a good night. Bye.